Right now, something very unusual is happening in the gold market, and most investors are completely missing it. Because on the surface, it looks confusing. Gold ETFs, the biggest institutional vehicles in the world, just saw one of the largest monthly outflows in history. We're talking about over $12 billion pulled out in a single month. That's not normal. That's not retail panic. That's institutional level movement. But here's where it gets even more interesting. Despite this massive outflow, global gold ETFs still added 62 tons in Q1 2026 and now hold around $606 billion in assets. So wait, money is leaving, but overall holdings are still rising? That doesn't make sense at first glance. And that's exactly why this moment is so important. Because this is not a simple sell-off. This is something much deeper. Before we move forward, make sure to subscribe to the channel and like the video. Let's break this down step by step. At the start of 2026, gold ETFs were on fire. In fact, just a few months ago, the market saw one of the strongest starts ever, with $5.3 billion flowing into gold ETFs in a single month, and a 9-month streak of continuous inflows. That kind of consistency only happens during major global uncertainty, and we've seen this before. During the 2008 financial crisis, during COVID, and now again in 2026. Then suddenly, everything flipped. In March, US-based funds like GLD and IAU saw heavy selling. North America alone recorded around $13 to $14 billion in outflows, leading the global decline. But here's the key insight. This wasn't because institutions lost faith in gold, it was because they needed liquidity. Markets were under pressure. The US dollar was strengthening. Interest rate expectations shifted. And when that happens, big players often sell their winning assets first, and gold was one of them. At the same time, something else was happening quietly. While the US was selling, Asia was buying, massively. Asian investors added around $2 billion into gold ETFs in March alone, continuing a record inflow streak. This tells us something very important. The gold market is no longer moving as one global block. It's splitting. On one side, Western investors taking profits and raising cash. On the other side, Eastern investors accumulating gold aggressively. And this shift could change everything. Because historically, when gold sees short-term selling but long-term accumulation continues, that's when the next major move begins to build. And now the big question is, are institutions actually selling gold, or are they quietly preparing to buy even more? Now let's go deeper into what institutions are actually doing, because this is where the real story begins. At first glance, those massive ETF outflows look bearish. But when you break down the data, a very different picture starts to emerge. Because not all selling is actually bearish selling. In fact, a large portion of these ETF outflows is what institutional investors call portfolio rebalancing. And this happens more often than you think. Here's how it works. When gold rallies strongly, which it did recently, it starts to take up a bigger percentage of large portfolios. For example, if a fund originally allocated 5% to gold and gold prices surge, that allocation might suddenly become 7% or even 8%. At that point, institutions don't panic. They simply trim their positions to bring the portfolio back into balance. So what looks like selling is actually just profit-taking after a strong move. And this is critical to understand, because it means the long-term conviction in gold may still be intact. Now here's another key layer most people ignore. While ETFs saw outflows, physical gold demand did not collapse. In fact, central banks are still buying aggressively. According to recent data, central banks have been adding over 1,000 tons of gold annually for multiple consecutive years, one of the strongest buying streaks in modern history. And remember, central banks don't trade gold for short-term profit. They accumulate it for long-term strategic reasons. Protection against currency devaluation, reducing reliance on the US dollar, geopolitical security. So while ETFs, which are more short-term liquid instruments, saw selling, the strongest hands in the market are still buying, and that's a powerful signal. Now let's bring this back to the United States, because this is where things get even more interesting. Right now, the biggest driver behind gold is not just demand, it's the Federal Reserve. Specifically, what the Fed is expected to do next. Markets are increasingly pricing in the possibility of interest rate cuts later in 2026, and this changes everything. Because when interest rates fall, the US dollar typically weakens, bond yields drop, and gold becomes more attractive. This is why, even during ETF outflows, gold prices have not collapsed. They've remained surprisingly resilient. In fact, every dip in gold recently has been quickly bought. And that's not retail investors doing that. That's institutional demand stepping in at lower levels. So what we're seeing right now is a classic setup: short-term pressure, but strong underlying support. And when these two forces collide, it usually leads to a breakout. Now, the big question becomes, if institutions were selling for liquidity and rebalancing, at what point do they come back? Because history shows they always do. Now, let's answer the most important question. If institutions were selling gold ETFs recently, when and why do they come back? Because timing this shift is where the biggest money is made. And the answer lies in one word: liquidity. Institutional investors don't move randomly. They move when global liquidity conditions change. Right now, markets are in a transition phase. Earlier this year, the US dollar strengthened. Bond yields moved higher, and that created pressure across assets, including gold. In that environment, institutions typically sell liquid assets, raise cash, reduce risk, and gold ETFs like SPDR Gold Shares and iShares Gold Trust are among the most liquid gold instruments in the world. That's why they're often sold first. Not because gold is weak, but because it's easy to sell. Now here's the turning point. When liquidity conditions start to improve, meaning the Federal Reserve signals rate cuts, the US dollar begins to weaken, bond yields start to decline. That's when institutions reverse. And historically, this reversal happens fast. We've seen this pattern multiple times. In 2020, during the COVID crisis, gold ETFs saw massive inflows once the Fed started injecting liquidity into the system. Billions of dollars flowed back into gold within months, and gold prices surged to record highs. Now look at today's setup. Markets are already expecting potential rate cuts. Economic data in the US is showing signs of slowing, cooling job growth, mixed manufacturing data, pressure on consumer spending. This is exactly the kind of environment where gold starts to shine again. And here's the key insight most people miss. Institutions don't wait for confirmation. They position early. Which means, by the time headlines say gold is rising again, smart money has already moved. Now let's bring ETFs back into focus. Even after recent outflows, major funds like SPDR Gold Shares, GLD, iShares Gold Trust, IAU, still control hundreds of billions of dollars in gold exposure. These are not small players. When flows return to these ETFs, they don't just nudge the price, they move the entire market. And we're already seeing early signs of stabilization. Outflows are slowing, prices are holding key levels, and volatility is compressing. This combination often signals one thing: accumulation phase. This is where institutions quietly build positions, without attracting too much attention. Because once the momentum starts, it becomes much more expensive to enter. So right now the market is asking, is this just a pause before another sell-off, or the calm before a major move higher? Because if ETF inflows return, it won't be gradual, it will be explosive. Now let's connect everything together, because this is where gold and silver both come into play, and where the opportunity becomes even bigger. Up until now, we focused heavily on gold ETFs. But here's the truth. Gold and silver never move in isolation. They are deeply connected. And right now, that connection is sending a very powerful signal. Let's talk about the gold-silver ratio. This ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. And recently, that ratio has been rising again, which means gold is outperforming, silver is lagging behind. At first, that might look like weakness in silver, but historically, this is actually the early stage of something much bigger, because in most major cycles, gold moves first, safe haven demand. Silver follows later, higher volatility plus industrial demand. We saw this pattern clearly in 2020. Gold surged first, then silver exploded shortly after, outperforming gold significantly. Now look at today's environment. Gold is holding strong despite ETF outflows. That tells us there is underlying strength. But silver? Silver is still reacting to multiple pressures. Industrial demand concerns, especially from China and manufacturing, short-term economic slowdown fears, higher sensitivity to interest rates, and that's why silver has been more volatile. But here's the key opportunity. When institutional money returns to gold ETFs, it rarely stops at gold. It starts there. Then it spreads. And one of the biggest beneficiaries of that shift is silver. Now let's bring in ETF data for silver. Major Silver ETF, iShares Silver Trust, SLV. This fund tracks physical silver demand from institutional investors. And just like gold ETFs, silver ETFs also saw mixed flows recently. But here's the difference. Silver markets are much smaller than gold, which means even a small inflow can create a much bigger price move. That's why silver is often called gold on steroids. When momentum builds, silver doesn't just rise, it accelerates. Now combine this with what we discussed earlier, potential Fed rate cuts, weakening dollar expectations, continued central bank gold buying, institutional rebalancing nearing completion. All of these factors point toward one thing, a shift from defensive positioning to opportunistic accumulation. And when that shift happens, gold moves first, silver follows. And then retail investors finally notice. But by that time, a large part of the move is already gone. So right now, we are sitting at a very critical point in the cycle. Gold is stable, ETF outflows are slowing, silver is lagging, and institutions are watching closely. The only thing missing is the trigger. And when that trigger comes, the move could be fast, aggressive, and very difficult to catch late. Now let's bring everything together, because this is where the full picture becomes clear and where you need to pay very close attention. What we're seeing right now in the gold market is not a collapse. It's a transition from short-term selling to long-term positioning. And the biggest clue is this. Despite billions of dollars leaving ETFs, gold prices have not broken down. That alone tells you something powerful is happening beneath the surface. Because in a true bearish market, prices don't hold. They fall sharply. But gold? It's absorbing selling pressure. And that's usually a sign of strong hands stepping in quietly. Now think about everything we covered. Massive ETF outflows, but still strong overall holdings. Institutional rebalancing, not panic selling. Continued central bank accumulation. Growing expectations of rate cuts from the Federal Reserve. A shifting global demand pattern. West selling, East buying. Silver lagging, but setting up for a potential explosive move. When you combine all of this, you don't get a bearish picture, you get a setup. And historically, setups like this don't last long. They resolve with momentum. Now here's the critical question you should be asking. What happens when ETF inflows return? Because they will. And when they do, they won't come in slowly. They will come in aggressively. Billions of dollars moving back into funds like Spider Gold Shares, GLD, iShares Gold Trust, IAU. And when that happens, gold doesn't move quietly. It moves fast. And silver? It usually moves even faster. So the real opportunity is not when headlines confirm the trend. It's right now, when the market still feels uncertain. Because uncertainty is where smart money positions itself. Clarity is where retail investors arrive late. So whether you're watching gold for protection or silver for opportunity, this moment matters. Because markets don't ring a bell before they move. They shift quietly, and then suddenly. If you want to stay ahead of these moves and understand what smart money is doing in real time, now let's take this one step further. Because understanding the setup is important, but knowing what to watch next is where the real advantage comes in. Right now, the gold market is sitting at a turning point, and there are 3 key signals that will tell you, before everyone else, whether institutions are truly buying the dip. The first signal is ETF flow reversal. Over the past few weeks, we've seen heavy outflows, but markets don't stay in one direction forever. The moment you start seeing consistent daily inflows into major funds like Spider Gold Shares, GLD, and iShares Gold Trust, IAU, that's your early confirmation. Not headlines, not opinions, real money moving back in. And historically, the first few days of inflows are often the most important, because they signal that institutional positioning has started again. The second signal is US bond yields. Gold has an inverse relationship with yields. When yields rise, gold struggles. When yields fall, gold gains strength. So if you begin to see US Treasury yields trending lower, especially on the 10-year, that's a strong indication that gold could start its next upward move. And this ties directly into the third signal, the US dollar. If the dollar starts weakening, even slightly, it reduces pressure on gold. And in many past cycles, the combination of falling yields, weakening dollar, returning ETF inflows, has led to some of the most powerful gold rallies. Now here's where it becomes even more interesting. These signals don't just affect gold, they amplify silver. Because once momentum builds in gold, capital begins to rotate. And that rotation often moves into silver through instruments like iShares Silver Trust, SLV. And since silver markets are smaller, the impact is faster and more aggressive. This is why in many cycles, gold confirms the trend, but silver delivers the biggest percentage gains. So if you're looking at this market right now, don't just ask whether institutions are buying the dip. Ask a better question. Are the conditions forming that force them to come back? Because institutions don't act randomly. They respond to macro conditions, and those conditions are starting to align. ETF outflows are slowing, rate cut expectations are building, economic data is softening, and global demand is still strong. All of this points toward a market that is not breaking down, but preparing for its next move. The only thing left is the trigger. And when that trigger appears, it will not wait for everyone to be ready. It will move with speed. And by the time most investors react, the opportunity will already be in motion. That is why tracking these signals now matters more than ever. Make sure to subscribe to the channel and like this video, because here we break down the signals that most investors miss. And right now,